valuations are still pretty reasonable on the internet. If you look relative to software and technology, you still at a material discount. We still can get to effectively $10 of earnings power from Facebook in 2 years out, and you put a 20 or 25 multiple, you still have material upside. So to back up Mark's point, we still like Facebook. It has had a big run, up over 35% year to date. So we're a little cautious going into the print given the magnitude of the run, but believe fundamentals are still there and valuation support still exists. It's a little bit higher across the other tech sectors that we cover. So I think there's a little bit bigger expectation going into software versus internet this Q1.
Hey, Mark, looking at both your universe and Brent's universe, a lot of outperforms, but neither one of you for Twitter. What's the problem?
Twitter is an asset that surprised me with how well it fundamentally recovered and how well the stock did over the last 2 years. I think they have a little bit of a challenge this year in terms of just tough comps, and margins probably need to come down. Tough comps, this company had a couple of really nice events last year, including the World Cup, which generated nice 30 to 40 million in incremental revenue. So they're going to be comping against that this year. And then all of that spend, do you remember that Facebook kind of amped up on last year in order to for platform security? I think Twitter needs to kind of do some of the same things, and they're sort of warning people. That's our interpretation, that margins need to come down a little bit. I just think that makes it harder for the stock to outperform. If we were going to get constructive on the stock, it'd be more of a timing thing. We'd wait, probably we'd be looking for this as more of a 2020 stock, not a 19 stock.
Brent, I want to dig into Facebook a little bit more. I mean, you got this report that the FTC maybe has the CEO, Mark Zuckerberg, in its crosshairs. There could be a multi-billion-dollar settlement there, for example. Obviously, it seems like every day, every week, we have another privacy or data issue with that company. Yet the stock continues to go higher right now, and the earnings continue to be strong based on what we've seen in recent quarters. What do you see as the biggest downside risks here?
I mean, regulatory is the number one question we get, but it's hard to understand what's going to happen. Remember Microsoft back in the day when regulatory overhang, when Ballmer was the CEO, and the stock went from 30 to over 100. So there's been regulatory concerns in the past that we've covered in tech, and we're paying attention, but we think a lot of that is in the stock, given some of these negative headlines. We think fundamentally advertisers are still getting the best ROI on the Facebook platform. You look at shopping, discovering new brands. I was just sitting on the couch, discovered a new men's pant line that I love. I'm wearing them right now. Sweat Taylor, great pants. You effectively are discovering these brands you would never get to in any other way, and these brands continue to pay up for that. So as Mark Zuckerberg called out, shopping remains one of the biggest opportunities. We think advertisers are continuing to come to the platform given the strength of their reach. And so we think regulatory is a big constraint, but every one of these platforms is under regulatory control. And we think if there is more regulation, the big platforms win and the little guys will lose. And that is consistent in a lot of the work we're doing.